Now we're going to take a look at what happens when we are the seller of merchandise. Previously, we looked at how we purchase the merchandise. Now we're going to take a look at what happens when we sell the merchandise. Here's a brief, so we have our net sales minus our cost of goods sold equals our gross profit. Every sale for a seller involves two parts. So this is really important. Every time you have a sale as a merchandiser, you have the sale of the item and you have the removal of the item from inventory and recording it as cost of goods sold. So that looks like this. The first entry will show the sale. We have the sale on account. We sold $1,000 of merchandise. We debit accounts receivable, we credit sales. That merchandise cost us $300. In the second entry, we will enter cost of goods sold, $300, credit merchandise inventory. We take it out of our inventory. It's no longer available for sale. We have sales discounts we might offer to our customers just like we had purchase discounts on the other side. So it will be the same thing on our invoices. We'll show terms that are 2/10, net 30, for example. So here again, we have that credit sale where we sold it for $1,000. We recorded the cost of goods sold. Now, when the buyer pays within the discount period, we'll see the accounts receivable gets credited for the full $1,000. It's 2% discount. So we give them the sales discount, and we do that as a contra sales account. So it's a debit of a revenue account of $20, and we record the cash for $980. If the buyer does not pay within the discount period, so they pay after, we will just record cash for the full 1,000 and credit accounts receivable for 1,000. Sales returns and allowances. Again, this is just like the purchase returns and allowances, except we'll handle it differently on the seller side. So we might have instances where we shipped something or sold something to someone and we need to give them an allowance. Either it's damaged, we might have shipped the wrong thing, they decided to keep it. And so now we will send them a credit memo and we will record this in sales returns and allowances. Notice this is also a debit account that will be in our revenue section. So in this particular case, we have a customer returning merchandise, which we sold to them for $15 and it had a cost of $9. If they return the goods and they're not defective, we can sell them again. Then we're going to put them back into inventory. So debit to merchandise inventory for the $9 and credit cost of goods sold for the cost $9. If the goods are defective, we will put back into merchandise inventory. It looks like we must have in this one partially defective and partially not, because we've got merchandise inventory for $2 and a loss from defective merchandise for $7, and the cost of goods sold gets credited for $9. So in a nutshell, if it is not defective and it's a return, we put it back into our inventory and credit cost of goods sold. If it is defective and there's some salvage value to it, we put that portion back into merchandise inventory. The balance we take to a loss from defective merchandise. In this case, our buyer decided to keep the defective merchandise, so we simply give them the credit. So we'll debit sales returns and allowances, and it looks like we paid cash. We gave them cash for that of $10 cash back. You could also possibly have a credit to accounts receivable if they haven't paid that bill yet. So let's take a look at exercise 4-4 on page 176. Exercise 4-4, we have Allied Merchandisers, which was organized May 1st, and their company, Macy Company, is the buyer, you're Allied the seller. You're to prepare journal entries to record the transactions for Allied the seller. Allied made the first and only purchase of inventory for the period on May 3rd for 2,000 units at a price of $10. cash per unit. So we purchased merchandise. So this is from our last entries where we were the buyer. We're going to purchase merchandise inventory, debit that for 20,000. You're going to credit cash because this was a purchase of cash, it tells us. On May 5th, they sold 1,500 of the units for $14 per unit under credit terms of 210 net 60, and the goods are in our inventory at 15,000. The goods cost us 15,000. So the first thing that we do is we record the sale. Remember, we have two parts to every sales transaction. So we sold the inventory on credit. That will be a debit to accounts receivable for 21,000, and we will credit our sales account for 21,000. Next, we have to remove those goods from our inventory account, and we now are recording them as a cost of goods sold because that's the cost of the units we sold for $21,000. We paid $15,000 for them. Our gross profit on that is $6,000. Cost of goods sold gets debited for $15,000. Merchandise inventory is a credit of $15,000. On May 7th, Macy returned 125 units because they didn't fit their customer needs. Not defective, the goods were returned to us. So we will put this in our sales returns and allowances for $1,750 was the invoice amount. They've returned it to us, so we'll take it out and we will credit their accounts receivable account for $1,750. And just like when we sold the goods, we had to take them out of inventory because we no longer had them for sale. Now they're sending them back to us, so we have to put them back into inventory because we can resell them. So we'll put them back into inventory, merchandise inventory. That will be a debit for $1,250. It tells us that was the cost of those goods. And we will credit the cost of goods sold because they are no longer sold. So we will remove them from that account. On May 8th, they discovered that 200 units were scuffed, but still of use, and therefore they kept the units. So here we have defective units, and we give them a price reduction and allowance and credit their accounts receivable for $300 to compensate for the damage. So here we again use our sales returns and allowances, and the amount will be $300, and we'll credit the customer's accounts receivable for $300. However, the goods are still sold. We don't have them to sell again, so we don't do anything with the merchandise inventory when we don't take the goods back. This is just an allowance for some damages that they had to the merchandise that they bought. On May 15th, Allied received payment from Macy for the amount owed on the May 5th purchase, net of the returns and allowances, and they also qualified for the cash discount, which was, again, the terms were 210 net 60, so 2% of the remaining balance. All right, so let's take a look. We initially sold for 21,000. Then we had a sales return for 1750. So let's get this up here. So we had 21,000 minus 1750, and then minus 300 was our last allowance that we gave them. So they owe us currently $18,950. That will be the credit to accounts receivable, and we're going to take 2% of that, which is $379. That will be the discount amount. So over here, let's do our sales discount. And I'm going to just make sure that my math was good, so I'm going to do it within Excel. So I know that it is my original sales number up here, the accounts receivable, minus this return, and then minus this allowance, and multiply that by 2%. And it was $379. We know that we need to record some cash here, right? And cash will be the difference between what we take from accounts receivable and the sales discount amount. So let's get that accounts receivable credit. I know that again, I can just come up here and grab my information. It's the 21,000 minus the 1750 minus the 300, 18,950. So the cash that Macy is going to pay me is 18,950 minus that sales discount of $379. So cash of $18,571. Okay, let's pause here and you take a look at number 3 in your workbook and number 4 and come back and review the solutions. In number 3, you started with QS48 and you recorded the sale of merchandise, so the accounts receivable debit, credit to sales. Then we recorded the cost of that merchandise that we sold, 2 transactions for every sale. On April 4th, we had a return of merchandise for full credit, so we debited sales returns and allowances, credited accounts receivables, and the goods were returned to us not defective, so we put them back into our inventory and took them out of cost of goods sold. On April 8th, we sold goods again for $1,000 that had a cost to us of $700. And on April 11th, we received payment from the April 1 sale less the return on April 4. So the April 1 sale was $3,000 minus the return on April 4 of $300. So we received cash of $2,700, and that should actually be accounts receivable. There you go. Credit accounts receivable for the $2,700. And that is that for that. And on number 4, you're asked to select the term from the drop-down box that most closely matches the definition. So you can take a look at that and see if you got them right. If not, take a look at the definitions again and make sure that you understand it. And that concludes this lesson.